How do you determine real estate market is rising? Because that's a million dollar question people want to know. Before I go and explain you, please do not forget to click on the subscribe button so that you're not missing out any important video from me next time. We don't know, I'm Bharat, working as an independent buyers consultant at Cashflow Properties. I help people to achieve financial freedom based on their circumstances. So yeah, I have been asked these questions number of times from my clients saying, "Hey, Bharat, how do you know exactly when the market is going to rise?" So look, there are the three things I would like to narrow it down, which might be useful for you in case if you are looking to upgrade your property or trying to invest into property. So number one, you need to know the real time activity of that particular market. What does that mean is you need to know how many properties are available in the market, how long the properties are staying, which is called the days on the market. Shorter the days, higher the demand. So you need to know exactly how exactly many properties are available and how long it take in terms of listing the property and settling the property. Second, how many owner occupiers are actually trying to either sell their home or trying to upgrade their home in that particular market? Because look, I do not like to invest into a market where it is being driven by the investors only. Most of the growth you will see from your property will be from the owner occupier market for a long term growth. So yeah, you need to look at those owner occupiers activity, days on the market. The second most important point is you need to know where the vacancy rates are dropping and rents are rising. Normally, when the vacancy rates, which is like how many properties are available for rents and how many people are missing out on the property, based on that complex formula, a term called the vacancy rate. So, tighter the vacancy rate, there will be more demand in terms of the renting the property out. More demand will there be in terms of renting your property out, and if the stock is not available, that is where rental vacancy will become tighter and tighter. The more tighter rental vacancies are, the more people trying to sort of increase their price before they decide to sell, because there will be competition from investors, from owner occupiers as well. So tighter the rental vacancy, there will be more demand in future, and that's where the sales price is going to rise. Last not important point is you need to check out exactly what's happening in that particular market from infrastructure point of view. Look, there are two kind of the infrastructure where, for example, if you are sort of buying in Sydney and Melbourne, you need to look at exactly how many infrastructure projects are coming in that particular area so that you can go ahead into that kind of the market and then start investing into the market to get the benefit early. So you need to look at for the infrastructure, you need to look at the population change. You need to also look at how internally people are migrating from one place to another place. For example, there will be a number of reasons why people can move from Sydney to Adelaide, for example, or Sydney to Queensland, for example. So you need to follow that trend as well. So just to narrow it down, number one point you are looking is the actual activity in that particular market driven by the owner occupiers. Second is the tight rental vacancy and the rent has to rise in that market. Last not least, the overall local economy of that particular market. So as long as you can try to research into that kind of the location, generally speaking, that market is a good sign in terms of investing into that market early to reap the rewards later on. I hope you enjoy my video. Again, please do not forget to click on the subscribe button so that you're not missing out next time from me.